Hello everybody, welcome back to my channel. So the removal of indexation for capital gains and introduction of a flat tax rate of 12.5% for long-term capital gains bring significant changes. Let's dive into the pros and cons, supported by some hypothetical examples to understand the impact. If you are new to my channel, I request you to subscribe and hit the bell icon below so that you can get notified when I post new videos. So, what is indexation? Indexation adjusts the purchase price of an asset using a price index, reflecting inflation over the period the asset was held. This reduces the taxable gain, effectively lowering the tax burden. Now we will discuss some pros of indexation. Inflation adjustment reduces tax burden. By adjusting the purchase price for inflation, the taxable capital gain is reduced, leading to lower tax liability. Fairer taxation ensures that taxpayers are not taxed on the inflationary increase in the value of their assets, only on the real increase in value. Encourages long term investment, promotes saving and investment. By providing a tax advantage for holding investments over a longer period, indexation encourages savings and long term investment, which can be beneficial for economic growth, protects against inflation, maintains purchasing power. Indexation helps in maintaining the purchasing power of investment returns, ensuring that investors are not disadvantaged by inflation. Clearer financial planning, predictable taxation helps investors in better financial planning as they can predict their tax liability more accurately by considering the effects of indexation. Now we will discuss some cons of indexation. Complex calculations, administrative burden. Calculating indexed cost requires access to inflation indices and can be complex, increasing the compliance burden on taxpayers and tax professionals. Tax revenue impact. Lower government revenue. By reducing the taxable gains, indexation can lead to lower tax revenue for the government, which might impact public finances. Potential inequities favoring wealthier investors. Indexation benefits are more significant for those with larger and long term investments, which may favor wealthier investors disproportionately. Inconsistent application. Varied application. The benefit of indexation might not be uniformly available across all asset classes and type of investment, leading to inconsistencies in tax treatment. Now we will discuss some pros and cons of removal of indexation. Pros of removal of indexation. Simplicity. The tax computation becomes straightforward without the need to adjust for inflation. Predictability. A flat tax rate provides predictability, making it easier for investors to plan their finances. Cons. Higher tax burden. Investors may end up paying more tax as the benefit of inflation adjustment is removed. Reduced return. Long term investors may see a reduction in their net returns due to higher taxes. Now we will see some pros and cons of flat 12.5% long term capital gain tax rate. Pros of flat 12.5% LTCG tax rate. Uniformity. A single tax rate across all asset type simplifies the tax regime. Lower rate for some. For assets previously taxed at higher rates, 12.5% represents a tax cut. Cons. Potential increase for others. Assets that benefited from indexation might incur a higher tax burden without it. Impact on long-term investors. Those holding assets for longer period could face higher taxes compared to the indexed regime. Now let's go over to an Excel sheet and with the help of hypothetical example, let us try to understand the impact of removal of indexation and flat 12.5% taxation of capital gain. So here we have two hypothetical examples. For each of these, we will calculate taxable gains with and without indexation and tax on long-term capital gains at 20% with indexation and at 12.5% without indexation. So hypothetical example 1, property purchased in 2005. The purchase price is 15 lakh. Property was sold in 2024. The sale price is 60 lakhs. The holding period is 19 years. Cost inflation index for 2005-2006 is 117. Cost inflation index for 2023-24 is 348. Now first we will see calculation with indexation. Indexed purchase price in this case is 44 lakh 61 538. Taxable gain, that is sale price minus the indexed purchase price, is 15 lakh 38,462. So tax at 20% in this case comes up to 3 lakh 7,692. Now we will see calculation without indexation. Taxable gain, that is sale price minus the purchase price, is 45 lakh. Tax at 12.5% without indexation comes up to 5 lakh 62,500. So here we have a comparison table with indexation and without indexation. First is taxable gain is with indexation comes up to 15 lakh 38,462, and without indexation taxable gain comes up to 45 lakhs. Tax at 20% with indexation comes up to 3 lakh 7,692, and tax at 12.5% without indexation comes up to 5 lakh 62,500. So in this example, there is a higher tax burden of 2,54,808. So in this case, there is a simplification of calculation. When new regime is applied, it simplifies the calculation by removing the need for indexation. Higher tax burden. In this example, the taxable gain without indexation is significantly higher, leading to a higher tax amount. Now we will see hypothetical example 2. Property purchased in 2017. Purchase price 35 lakhs. Sale price 65 lakhs. Property sold in 2024. Holding period is 7 years. Cost inflation index for 17-18 is 272. Cost inflation index for 23-24 is 348. Now we will first calculate with indexation. Indexed purchase price comes up to 44 lakh 77,941. Taxable gain, that is sale price minus index purchase price, comes up to 20 lakhs 22,059. Now we will see tax at 20% with indexation comes up to 4 lakhs 4,412. Now we will see calculation without indexation. Taxable gain, that is sale price minus purchase price, comes up to 30 lakhs, and tax at 12.5% without indexation comes up to 3 lakhs 75,000. So here we have a comparison table with indexation and without indexation. The taxable gain with indexation comes up to 20 lakhs 22,059, and without indexation taxable gain is 30 lakhs, and tax at 20% with indexation is 4 lakhs 4,412, and tax at 12.5% without indexation comes up to 3 lakhs 75,000. So in this case, we have a lower tax burden of 29,412. So without indexation, the calculation is simplified. In this case, there is a lower tax burden. The tax amount without indexation is lower, demonstrating the benefit of a flat 12.5% rate for assets held for a shorter duration. These examples show that while the removal of indexation generally increases taxable gains, The flat 12.5% tax rate can lead to a overall lower tax liability in some cases, particularly for properties held for a shorter period. The simplification of capital gain taxation through the removal of indexation and the implementation of flat tax rate aim to make the tax system more straightforward. With this benefits the ease of calculations, it can also lead to higher tax liability for long-term investments. Conversely, short-term investors may find the new flat rate beneficial. The overall impact depends on the duration of the asset holding and the type of asset involved. Taxpayers should evaluate their specific scenarios to understand how these changes affect their tax liabilities. Thank you for watching the video. If you found this video useful or informative, please like and share the video and do subscribe to my channel. I will see you all in the next video.